As someone who has obsessed over and analyzed high-growth stocks for years, I can tell you with absolute certainty that what we are looking at today is, well, it's unlike anything in financial history. Today we're doing a completely impartial, incredibly deep dive into Nvidia's Q1 FY 2027 earnings from May 20, 2026. And let me tell you, this isn't just your standard earnings beat. It's this high-stakes, deeply emotional story of a company operating at a scale that is almost incomprehensible. We're going to unpack the staggering, frankly exponential growth that has propelled this stock into the stratosphere. But we are also going to take a really hard analytical look at the lurking risks, the geopolitical ceilings, and the fierce valuation debates that are absolutely tearing the market in two right now.
To really wrap your head around Nvidia today, you honestly just need to look at this one single number: 92%. That is the exact portion of Nvidia's revenue that now comes entirely, exclusively from its data center segment. Think about that for a second. For an investor, witnessing a company that started way back in 1993 making video game graphics completely morph into the literal backbone of global AI infrastructure, it's staggering. It really is. That original gaming business, financially speaking today, it's effectively a rounding error.
So here is our roadmap for today's explainer. First, we'll cover the $81 billion quarter. Second, the AI toll booth. Third, looming risks and challenges. And finally, the valuation debate.
Okay, let's jump right into Section 1, the $81 billion quarter, breaking down the boom. The sheer gravity of these numbers is just breathtaking. Nvidia reported a record revenue of $81.6 billion for a single quarter. Guys, that is an 85% year-over-year increase from the $44.1 billion they reported just 1 year ago, completely shattering Wall Street's already lofty consensus by over $2.6 billion. But honestly, the profitability is what truly stands out here. They achieved a non-GAAP gross margin of 75%. Now, in the hardware space, margins are traditionally razor-thin, so keeping 75 cents of every single dollar as gross profit on an $80 billion scale, that is an economic reality we usually only ever see in absolute software monopolies. It is a total financial boom.
And you can really see the historical shift that happened here. Over the last few years, the compute and networking segment completely eclipsed the traditional graphics segment. The market effectively forced a corporate rebrand on them. Nvidia is no longer a GPU company that just happens to sell to data centers, right? They are a data center company that happens to make GPUs.
Nvidia actually transitioned to a brand new reporting structure just to reflect this massive shift. Data center pulled in a massive $75.2 billion, which is up 92% year over year, leaving edge computing sitting way back at $6.4 billion. And this explosion, it's driven by a sustained, completely insatiable demand for their Blackwell architecture. You've got cloud providers, massive enterprise customers, even sovereign nations racing to build out compute capacity, buying full-stack systems literally by the thousands. The main takeaway you should have here is that Nvidia isn't just selling a piece of a computer anymore. They are selling the entire brain of the data center.
Moving on to Section 2, the AI toll booth. How exactly Nvidia makes its money?
The mechanics of this total market dominance really start with two key concepts you need to understand. First is agentic AI. These are AI systems that don't just, answer questions or spit out text, but actively take actions and solve really complex problems all on their own. This generates actual economic value and crucially requires massive compute power. Second, we have hyperscalers. These are the giant cloud providers, think Google, Amazon, Microsoft. Right now, just a handful of these hyperscalers contribute to over 50% of Nvidia's total revenue as they drive literally the largest infrastructure build-out in human history.
But you might be wondering, why do these hyperscalers keep buying exclusively from Nvidia? Well, it's because Nvidia has built an incredibly deep moat. First off, they operate on a capital-light, fabless model. They hire TSMC in Taiwan to manufacture the actual physical chips, which lets Nvidia pour all of its resources directly into research, design, and software. And listen, that software is the ultimate trap. Their programming model, CUDA, is deeply entrenched. Enterprise developers are completely reliant on it to build and train their models. So, moving away from Nvidia hardware, it means rewriting massive amounts of code and retraining your entire developer workforce. That sticky software ecosystem is exactly what gives Nvidia its 75% gross margins and, frankly, unbelievable pricing power.
And management sees absolutely no sign of this slowing down. CEO Jensen Huang has put a massive, audacious flag in the ground: $1 trillion. That is the target Nvidia has set for cumulative AI chip revenue by the end of 2027. Now, to be clear, this isn't a single year's revenue, but the combined aggregate orders they expect to fulfill from their current Blackwell chips and the upcoming next-generation architecture, Vera Rubin. They are betting incredibly heavily that the global appetite for AI infrastructure is not going to be satisfied anytime soon.
Which brings us to Section 3, looming risks and challenges. Because as investors, we know there's always a catch, right? Despite those astronomical numbers, there are serious structural problems and severe geopolitical ceilings threatening Nvidia's growth right now in 2026. Listen to this pretty dramatic admission from Jensen Huang regarding the Chinese market. We've evacuated that market. Huawei had a record year. They'll likely have an extraordinary year coming up. Just a few years ago, Nvidia held 95% of China's advanced chip market, and China accounted for a full fifth of the company's global revenue. Today, their advanced chip market share there has essentially evaporated. As an investor, watching a guaranteed 20% revenue slice just vanish overnight, that is a terrifying prospect.
And the thing is, this evacuation wasn't by choice. US government export restrictions, heavily citing national security concerns, completely blocked the delivery of Nvidia's top-tier A100, H100, and those highly coveted new Blackwell chips to China. So to comply, Nvidia was forced to create the H20 chip. This is an intentionally throttled, less powerful chip designed specifically just to get past export controls. By forcibly removing their best products from the table, a massive $50 billion AI market was left wide open for domestic Chinese competitors like Huawei to just step in and dominate.
But the competition isn't just isolated to China. Remember those hyperscalers we talked about that make up over half of Nvidia's revenue? Yeah, they are actively trying to reduce their reliance on Nvidia. Google, Amazon, and Microsoft are all heavily investing billions in developing their own custom in-house silicon. The ultimate irony here is that Nvidia's absolute biggest customers are rapidly trying to become their biggest competitors. Add in traditional rivals like AMD aggressively pushing its MI300 series and Intel making a really strong push with its Gaudi accelerators, suddenly that 75% margin becomes a giant target painted right on Nvidia's back. And that leads us to Section 4, the valuation debate. Is the stock undervalued or overvalued?
This explosive, truly unprecedented growth, matched with rising existential threats, brings us to arguably the most fiercely divided topic on Wall Street right now. Let's objectively weigh both sides here. The bull case says the AI cycle is stronger for longer. Nvidia just guided a staggering $91 billion in revenue for Q2 of FY27, and that is excluding potential China revenue entirely. Plus, they hiked their dividend by 25 times and announced a massive $80 billion stock buyback. That signals immense, unwavering management confidence. On the other side, the bear case argues that 75% gross margins are peak economics, and they are mathematically unsustainable. Bears argue that as those hyperscalers eventually hit their $725 billion capital expenditure limits, spending fatigue is going to set in. Margins will inevitably normalize downward as the market matures, and this new wave of competition eats away at their pricing power.
This brutal tug-of-war has created violent volatility. Over the past 3 years, Nvidia has crushed the broader market, returning over 650% compared to the S&P 500's 38%. But the jagged reality of that climb reveals a stock that whipsaws wildly every single time the market panics over hyperscaler spending budgets or hears a whisper about new export restrictions. It really proves just how hypersensitive this valuation is to any hint of a slowdown. And this volatility is perfectly reflected in these wildly divergent analyst forecasts for 2027. We cannot summarize this because the details matter. On one end, bullish models like the Long forecast predict the stock will surge past $400, specifically hitting $482 by late 2027, based purely on forward earnings momentum. But then, on the exact flip side, you have institutional analyses from the Cross Fund and the Henry Fund issuing a very cautious hold rating. Their intrinsic value models, which actually factor in long-term margin decay and that incoming wave of competition, value the stock significantly lower. They are projecting around $190 to $206, which, mind you, is actually below current trading levels. This leads us directly into what we call the PE compression theory. Look, Nvidia cannot mathematically grow at 85% indefinitely. Bank of America actually expects their growth to moderate down to 30% next year and then fall to about 13 or 14%. As an experienced investor, this is exactly where I look at the PEG ratio, the price to earnings to growth ratio.
If we compare Nvidia's PEG ratio against similar mega-cap tech stocks in the industry, a shrinking growth rate means its current premium PE multiple of 45x becomes incredibly hard to justify. Think about it. If growth drops, the G in that ratio plummets, making the stock look terribly overvalued. If that P multiple compresses from 45x down to 30x, even if Nvidia technically continues to grow its actual bottom-line earnings, the stock price itself could easily stagnate or even fall. The PEG ratio tells us that relative to its slowing growth, it may simply no longer be the undervalued steal it was 2 years ago. That is the harsh mathematical reality of high-growth investing.
So the absolutely crucial point really comes down to this one provocative question. Are 75% margins the new normal for global computing? Or are we staring right at the absolute peak of the AI infrastructure cycle? I mean, if you believe CUDA's software moat makes Nvidia a permanent, unshakable monopoly, then this stock still has immense room to run. But if you believe that incoming competition and hyperscaler spending fatigue will inevitably bring those margins back down to earth, well, we might just be standing right at the summit.
And that, folks, is the multi-trillion-dollar reality check. Please remember, this explainer is strictly for educational purposes and is absolutely not investment advice. The semiconductor market is incredibly complex, heavily geopolitical, and extremely volatile. Everyone should conduct their own thorough research and consult with a professional financial advisor